Welcome back to Rich Owl. In November 2021, Bitcoin hit $69,000. Every YouTuber screamed it was the start of something bigger. 5 years later, the math tells a different story. Bitcoin has spent more days below that 2021 high than above it. And here's the part that nobody on crypto Twitter wants to admit. Each of Bitcoin's last 3 bull cycles has produced smaller returns than the last. 100x, 20x, 4x, less than 2x. The line goes down. Bitcoin has already peaked. This is Rich Owl, where we break down the stories Wall Street and crypto Twitter would rather you not think too hard about. Today, I'm going to do something nobody else is willing to do. Tell you, with math instead of vibes, that Bitcoin is not the trade for the next 10 years. And I'm going to show you what is. 3 things in the next 8 minutes. First, why Bitcoin's S-curve has flattened and what the math says about the next decade. Second, 3 boring assets that will quietly outperform Bitcoin between now and 2036. And third, the exact trigger that ends the Bitcoin rally once and for all. None of this is anti-crypto. All of it is in the public data. Every technology adoption curve looks the same. Steep early growth, a long flat middle, and a top. Smartphones did it. Internet stocks did it in 2000. Cars did it in the 1920s. Bitcoin is doing it right now. In 2013, Bitcoin returned 100 times in 2 years. In 2017, 20 times. In 2021, 4 times. In 2025, less than 2 times. Each cycle produces about 1/5 the return of the previous cycle. If that math continues, the next Bitcoin bull cycle returns about 30%. That is worse than a Vanguard index fund. Bitcoin is now a $2 trillion asset. To do another 10 times return from here, Bitcoin needs to grow to $20 trillion, larger than every gold reserve, larger than every commercial real estate market, larger than Germany's GDP. The buyer of that 20 trillion is not retail. Retail Bitcoin holdings peaked in 2023. The only marginal buyer left is institutions through ETFs, and ETF inflows have already declined 4 quarters in a row. Inflation peaked in 2022, and Bitcoin fell more than gold. Bitcoin's correlation to the Nasdaq is 0.71. It trades like a tech stock, not like a hedge. Central banks bought a record 700 metric tons of physical gold last year. They bought 0 Bitcoin. If Bitcoin is the wrong trade for the next decade, what is the right trade? 3 assets the math actually likes. Number 1, long-duration U.S. Treasuries, ticker TLT. Right now, the 10-year Treasury yields 4.8%. The 30-year is over 5%. When the Federal Reserve cuts rates in the next 12 to 18 months, long bonds rally hard. In 2020, TLT gained 40% in 9 months as rates fell. You earn 5% while you wait, and you get a 20 to 30% capital gain when rates drop. Asymmetric. Number 2, physical gold, or the ETF, ticker GLD. Yes, your grandfather's investment. Gold hit a new all-time high every month for 14 straight months. The buyer? Central banks of China, Russia, Saudi Arabia, India, and Turkey. They bought 4,000 tons in the last 3 years. They are not buying for ideology. Bitcoin was supposed to capture that trade. Gold actually captured it. Bitcoin has gone sideways for 2 years. Gold has gone vertical. The market told you which one was actually digital gold. Number 3, quality dividend compounders. Cintas, Costco, Visa, Microsoft, Procter & Gamble. These businesses raise their dividends every year for 30-plus consecutive years. They compound at 12 to 15% annually with dividends reinvested. They survived 2022 while Bitcoin fell 75%. A diversified portfolio of dividend aristocrats, reinvested for 10 years, returned around 320%. Bitcoin returned around 500%, but with 3 drawdowns of more than 70%. Risk-adjusted, The boring stocks won. They will win again. Now, here is the trigger that ends Bitcoin's rally for good. It is one number: ETF net inflows. For 2 years, the only thing holding Bitcoin's price up has been a slow drip of institutional money. About $20 billion in net inflows since launch. That is the entire bid. Once those inflows turn negative for 3 consecutive months, the trend breaks. Q4 of last year declined for the first time since launch. Q1 of this year declined again. If Q2 finishes negative, that is the signal. Without the marginal buyer, Bitcoin retraces to its long-term trend line, which is around $45,000. From today's price, that is a 55% drawdown. Bitcoin in 2036. Best case, $200,000. That is 2 times from here. Sounds great until you realize gold could do the same with 1/3 the volatility. Bear case, Bitcoin in 2036 is between $30,000 and $50,000, which would mean a 60% loss from where you might buy today. The asymmetry is broken. The upside is capped. The downside is real. Bitcoin is not going to zero. Bitcoin is a real technology. But it is not the trade for the next decade. The trade is the boring one. Treasuries earning 5%. Gold quietly compounding. Dividend kings raising payouts year after year. Stay curious. Stay skeptical. Never confuse a great story with a great investment. I'm Rich Owl. Cheers. Stay curious. Stay skeptical. I'm Rich Owl.